All right, folks, this is being recorded. Something I mentioned at the beginning of most webinars anyways. Watch it again because some of these nuances will sink in if you watch it another time. If you wait too long down the road, folks, it's going to be like learning it all over again, to be quite honest. And you know what? I'm going to get you folks to a place where options just make sense. And I've geared this course specifically to introduce traders and investors to options. And I'm sure even this old floor trader can teach the savviest of traders out there. And I know there's a thing or two. Options can be intimidating, I'm not going to lie to you. But I'm going to build from simple concepts to real life examples throughout this webinar. And by the end, you should have a solid understanding of this particular strategy and options in general. And my goal is to get you folks to a place where you understand options intuitively. And I think I can do that for you quickly. I use a lot of logic when I'm going through this, so get your mind into that mindset. It's not just memorization here. What I want you guys to do as we're going through all of this is to really think about this logically and how it will all fit together. And at the end, that's how it will all fit together like a nice little puzzle and just make sense. An easy puzzle. All right, so we're doing swing trades. This week, we're going to be talking about the bullish risk reversal. So what I do on any given day is go through my charts and look for different kinds of setups. Now, it's not always just on a bullish move we go out there and buy option strategies. It just so happens when we're looking at these, I'm finding particular setups that fit with the bullish risk reversal. But what I try to do for you folks is go down this road like you guys were looking at it on any given day and how you would ultimately find yourself at a bullish risk reversal. All right, so we're doing swing trades. First thing we need to talk about really is what is a swing trade. And a swing trade really is just as simple as a trade lasting longer than 2 days, folks. I mean, that's really the definition. A day trade is intraday trading. You're in and out of a position. You're not carrying anything overnight. A swing trade really is usually, though, considered that you're basing it on some assumptions, technical setups, maybe it's the candlesticks, whatever that is, and you're looking for a quick move to the upside. That's the idea of a swing trade. And it usually is going to take longer than 2 days to have that happen. But generally the idea is it's longer than 2 days, shorter than a year. I don't know that I ever carry trades out longer than a year based on a swing setup, all right? Sometimes I will, and I'll show you an example of a really good one that is one of my favorites that you can consistently do these type of swing trades off of. And, without further ado, I guess we should actually, let me talk about it real quick. Swing trades. What is swing trades? It's really just trying to find, areas where the market is kind of making moves. You can see. All right, that pen is out the door. It was giving me troubles last week too. For some reason, it wants to automatically give me the change page. So really what we're looking at with these trades is something when the underlying is just trying to identify these moves, right? Like a swing trade, you're just trying to find what the underlying is doing, right? And that really is swing trades, is finding these opportunities like a candle like that, and a candle like this, right? Those are different types of areas. And then, a lot of people can go further. You draw in your lines. These are actually Fibonacci's, but those represent great areas of where this usually has a tendency to trade. So when we're trading these swing trades, what we want to try to do is identify, look at this underlying. What are they doing? How is this underlying reacting? Right? Let me do something like that, or I don't know. So ultimately what we're trying to do is, you identify the trend. That's bullish. We've got a sideways pattern. We've got a bearish pattern, right? And then you're going to go in and just try to identify areas where it has a tendency to slow down on the upside, or what we say is resistance areas. These are support areas, okay? Again, we can kind of draw a line and resistance, right? Support, right? Again, just kind of draw your lines down. And that's really what you're trying to do, is identify those as they're going along, because it will have a tendency to stay within those ranges if you set this up with a good underlying, okay? But what seems to happen here, right, is, you know, sometimes if you've done swing trades, you'll see it go like this, and then it'll gap higher or something, right? Or, you know, it might be trading sideways, and you think, okay, well, I got in here. I'm getting in because it's starting to rebound, and then all of a sudden it drops down to here, right? And then maybe starts going. Or, you know, it will have a tendency to flatline and doesn't ever go anywhere once you get in here, right? And then it just goes sideways. So those are things that, you know, we don't foresee happening because they were so consistent, like something like, you know, in this case, IBM, where you can almost, you know, do it on a clock, setting these strategies up where it comes up, hits the resistance, falls down to the support. But again, you know, what happens? This is a snapshot of today. You know, we were talking about last week or a couple of weeks ago, we were kind of topping out there, and that was looking for that move back to a point here, right? At least is the idea on these types of swing trades. But then it was looking pretty good, and then a gap higher, not only, and if you had added to that position or something, and then it just really jammed up, right, to a major second level here. So those are things that can happen with these swing trades. But what we're trying to do is identify those ranges. We can find the extremes, and using options, we can increase our probabilities of success. Even with something like IBM, where it's blown off the top here, we're going to have less risk, generally speaking, with strategies that go the wrong way on these swing trades. And it happens, you know, every so often. The probabilities will come around and bite us in the butt. But had you stayed with this strategy on this IBM, like, you know, I've been doing this trade in the daily market commentaries for almost a year now, where I've been trading this on a swing trade, covered calls, all of that stuff. So, you know, this is a great one for especially somebody getting introduced to options. If you wanted to put something like IBM in there, start off with covered calls or a swing type trade. IBM, if you look back, I started trading options with IBMs on covered calls back in the 80s, folks. All right. And it was trading around 100 and 110. It would go down to 95. That was a buying area. 110 was a sell area. I mean, where is it today? It's a little bit higher than that, but not much. All right. So had I stayed with a covered call strategy since then, I probably would have lowered my cost basis to well over zero, even with $100 stock. So we can use options to increase our probabilities of success. But ultimately, when we're looking to learn how to swing trade, the first thing we have to identify is that trend. And that is ultimately, are we going up, down, or sideways, right? That is the overall trend. And then we need to find those support and resistance areas, right? That's where, when the underlying is trading at in a bullish pattern like that, is identifying those support and resistance areas, right? And then ultimately, we want to find out what the pattern is within the overall trend. So in a, you know, like that would be the pattern if we were looking at a sideways. That's the pattern. It's reverting back to a bullish pattern inside of a sideways trend, okay? So we can always take advantage of that. You know, there's a saying, there's always a bear market out there somewhere. Well, that's because even inside of a bullish move, there's a bearish pattern possibly shaping up. You know, you could have a move where it's bullish, and then all of a sudden you're looking, hey, it hit that resistance area. Now we've got a bearish pattern within a bullish move, okay? So those are the types of things we're looking for, is identify, first thing is the overall trend, bullish, bearish, or sideways. Then find those support and resistance areas. And I can show you different ways that I use to find it. Everybody's got their little quirky thing. You know, there's a million different ways to skin a cat when it comes to technical analysis, guys. And I'm not gonna lie, probably traded most of them, to be honest. And I always come back to the tried and true things that I look at, and that's really the candles. All right. So why options? Because we got better odds. You know, our odds are better. Odds are better by far. You got much better odds. You can increase those probabilities of success. It also allows you, with many of these, to stay in this longer. All right, you can get involved early as well. You know, when you guys are trading, if you're trading with stocks, right, and they're telling you about these like support and resistance areas that we were talking about, and something like, you know, this IBM trade, you know, if this was the line, this 50 Fibonacci, right, and that was the resistance, and that would be a pretty good line in the sand that most people would talk about, right? If they're talking about Fibonacci, that 50 Fibonacci, you know, always comes around. Well, how often in the last year did it ever hit the 50 Fibonacci? Once. And then that was on the bad trade, right? So you're going to be able to increase the amounts of times that you're able to get involved in these trades, which, you know, with a high probability strategy, like we're going to be using with options, we know the probabilities, we can account for that. We increase our probabilities of success by using those options. We can also increase the amount of times. If you were looking at the 50, every time it got close, you could implement an option strategy around that. So you're not trying to pick an exact time or an exact price point, all right? That's one thing I hate about, you know, especially swing trades. And you can find those support and resistances, especially like the sports. And if I were to use this one, which is a little bit more aggressive on the red lines, right? If I were to use the red one, Fibonacci's, it's a little bit more aggressive. I have a lot more opportunities, but it also breaks through sometimes, right? It's breaking through a little bit more often than some others. But there's also much more opportunity, okay? You're not always getting worried about your pricing here. So we can get involved a little bit more often in this type of trade. All right, so ultimately, we can see this is a sideways trend, right? We've identified the support and resistances. In this case, you know, it busted that pattern, so I'm actually using this as one of those breaking. But again, it's kind of looking a little toppy here as well. A little overextended to the upside. So a swing trade possible setup there happening. I'm not going to go into my position with IBM right now. We'll talk about that later. In the daily market commentaries. So another, again, a real life example, bullish in the SPY, right? Bullish pattern. It's still on a bullish pattern. The reason why I brought this up for some of you guys that have been following along with these webinars that we've been doing, we kind of started out down here where we identified this as a bottom for a bullish trend, and sure enough, it has done that throughout. Sorry, I tried to go to get the mute button and I couldn't get it fast enough. So just again, here we have another bullish trend. Identifying that overall trend is a must when we're looking for a setup here, right? Again, now, so let's take a look at a real life example today. You know, actually, this came on my radar a couple of days ago, so, you know, I've been looking at it. And we can see that this is obviously an overall bullish trend, right? We got the overall bullish trend there, and I'm going to try and get some straighter lines. So if I can get arrow options, can I get a? All right, I'm going to just go with this one. So give me 1 second to set this one up. Actually, I want the straight line here. Go with yellow. All right, so, and then we can kind of draw lines up. These aren't going to be the greatest because I'm trying to do this quickly. Like support and resistances, those aren't perfectly straight, but you guys get the idea. We're going to identify now the support and resistances very well. Here's obviously the resistance line, support line. So we bounced off of that line quite nicely. As a matter of fact, when I drew it in on my computer, I used these, but bounced off that quite nicely. Yesterday, confirmation. So we got this nice hangman doji here at the bottom of a move, usually signaling that there's a reversal coming. Yesterday, so we got a confirmation for a move to the upside. Today, actually, it's really nice because it's set up for a bit of a pause here. Some people might worry about that being at the top of a move. It's not at the top of a move. We see those patterns happen a lot inside of a bullish move here. So I'm not going to be overly concerned about that. I would look at the way that the chart set it up at the end of the day, and I think it made it look like a little bit more of a pause. It kind of closed right around where it opened. So still, so we have a bullish trend, bullish pattern within the trend. This looks like it's getting ready to take off for me. I am looking at something to do with options. But first, let's talk about what are options for some of you folks that may be newer to options. Just a little bit of information here. All right, so a call buyer. Think about this from the call buyer's perspective. You have the right but not the obligation to buy that stock, right? That means if the underlying, if Mike buy a call and the underlying is way up here, I'm definitely wanting to buy at a lower strike, right? Those are very valuable. A call buyer up here, if the underlying is trading here, a call buyer, I'm using my hands and not everybody's going to see the video, sorry. So for you folks that are here at the video or during live session, you guys get that. But because the here and here is probably not going to work, so I got to rethink that. Call buyer has the right but not the obligation to buy the stock. So if your strike is below where the underlying is trading, then you obviously would want to buy that, right? Stock at a lower level. But if your call is way above where the underlying is, you don't want to buy a stock higher than where you could go out and currently buy it, right? So that is going to be the determination as to whether those calls are valuable or not, right? If they're in the money or below where the underlying is trading, those have a lot of value. You might very well want to buy a stock $100 below where it's currently trading. That might be a good idea for you, but you might not want to buy the stock $100 above where it's trading, all right? So that's the nice thing about buying a call is you have limited risk on that, right? The seller of the call has the obligation to deliver that stock at the call strike price, all right? If you don't have the stock, you end up being short. All right, the put buyer has the right but not the obligation to sell that stock, all right? So if you have a put and you bought a put, you have the right, if you wanted to, sell that stock at that price during the life of that option. Now, the put seller, on the other hand, has to buy the stock at the strike price if the other side of the trade wants you to take the stock away, all right? Or what we used to say, you have the stock put to you, all right? So we need to know those things because we're going to be using these, all right? So put seller has the obligation to buy the stock at that level, all right? Put seller has the obligation to buy that stock at that level. Another thing for some of you newer guys, we used to say, for you're watching the video, used to call up and put down, all right? Call up, put down. That's from the buyer's perspective. All right. Now, when we're trading options, we have to understand something about the option pricing, right? We have to know whether or not they're cheap or expensive, right? Why? Well, because I like to buy things when they're cheap and sell things when they're expensive. How about you? Anybody like to buy high, sell low? No, we don't. We like to buy things for value or undervalue, right? If I can buy it cheap, that's what I want. When I see it's expensive, I want to sell it. So we go over to the option montage, right? And we look at these options to see whether they're cheap or expensive. And I'm looking at all this pricing. Anybody tell me if they're cheap or expensive by looking at this page? Wheeler? No, you can't. But we do need to look at this number, okay? Vega. Vega is just volatility, all right? Vega for the calls and the puts, it's just volatility. But we need to look at Vega for this particular number, really, or any of these numbers for that matter. The Vega number, because it tells us implied volatility. You know, it's just a fancy way for saying implied volatility in a very short way. And they even call it a Greek, and it's not a Greek, but it's probably the most important Greek that got left out of the picture. But it's implied volatility, all right? So that number is important to us. But that 50, you know, if you're thinking 0 to 100 and 50 is right in the middle, that's not the right idea. 50 it just tells us where this underlying, we're still looking at MGM. I'm still looking at that same chart where we talked about the bullish trend, right? Now I want you guys to look down here, all right? We're looking right here, implied volatility. I put a chart up there because I want to know where implied volatility is. And implied volatility versus historical volatility. Implied volatility is forward-looking volatility. It is the expectation of future volatility. Historical volatility tells us where it's already been. I don't care about where it's already been. I want to know where expectation is, all right? I want a forward-looking everything. All the way down to my economic data points, I want them forward-looking, all right? So what we can do is look at 50. Now, if you guys remember when we were looking at, I think it was Goldman Sachs never got as high as 50. All right, when we were talking about range, it's important to look at that implied volatility number, but we have to put it into correlation of each individual underlying. Well, this one's volatility range is completely different than somebody else's probably, okay? So we want to look at MGM's specific implied volatility. Now, I also want to discount all of this stuff like pandemic stuff. I want to have the data set of this year. So we kind of need to take that out of the picture and need to know a couple of other things like how we determine the finite number here a little bit more. But what we can also see is like a swing trade, there are support and resistances, right? We can see this underlying has swing trades and, you know, comes down, finds support, hits resistance, kind of, right? So we can see that these have an area where they want to stay range bound. They're not usually like a bullish pattern or a bearish pattern. It's usually a sideways pattern. And we look for those support and resistances. And so we want to zoom in on that. So let's put in some better lines here. All right, so like I said, I want to discount all of this stuff out here. And as a matter of fact, you can find this implied volatility percent is what we're trying to find out here in a lot of different places on TOS, and I'll show you guys how to find that. But also, if you want to look at, you know, a data point where it's like 6 months out, I have the script where you can put that into your Thinkorswim as well, and then it erases all of this noise that happened before, all right? So we draw in these, you know, we got our resistance, now our support, right? We can see that it's at or near that very low. So we could obviously say that those pricing, just based on this, that those options prices are pretty cheap, okay? Ultimately, you can go as far as that. Eyeball it, all right? You know, here's the 50-50, right? So 50% is really what we're talking about. Anything above that, we look to sell. Anything below, we look to buy. Now, we are going to end up with the bullish risk reversal, folks, okay? And with this strategy, we're basically discounting a lot of this pricing, okay? But ultimately, we do want to know where volatility is in relation to determining our option strategy. But one of the beauties with the bullish risk reversal is we can negate a lot of these Greeks by using this strategy, all right? But at the end of the day, buy sell zone, or if you really want to look at it in detail, let's just say that this is 81 up at the top here, right? Draw that line across 81. This low, let's call it around 48, and we can see where the current is, right? So let me pull this thing out a little. All right, so we've got current. We take the current, implied volatility minus the low, implied volatility. You take that sum divided by the high, IV, implied volatility again, of this particular underlying minus the low, IV. All right. That's going to give us a little bit more finite detail here. All right, so current, we've got, what was that, 51. The low is 48. Take that sum and divide it by the high, which is 81, minus the low, which is 48. And that gives me 3 over 33. So what is that? It's right around 10%. All right, so let's call it 9%. So it's in the 9th percentile, which means it's very low. If it's at 0, that means it's as low as we've seen in the last 52 weeks, or in this case, the last 6 months. And if it's at 100, it means it's at the highest level we've seen in that data set point. All right. So we can see that these premiums are cheap based on looking at this. All right. Obviously, when they're here, we would say they were extremely expensive, right? If it was in and around that area. But, we're right here. So that's low. That's cheap, right? It doesn't mean it can't go lower, but what we look at it as, when it hits those extremes, right, hits that support area, it's kind of wanting to go back towards that 50 again, all right? Revert back, all right? So in this case, if we're asking ourselves, are options cheap or expensive? They're cheap, so we want to buy those options, right? So what's the rate option strategy? Well, buying options. Well, in this case, we don't care, because I want to look at what's going on around my strategy, right? I want to look at my strategy a little bit here. And we have to look at how this underlying is moving. And to me, one of the things I'm worried about, we've got a bullish pattern inside an overall bullish trend here, right? One thing I'm worried about is we're at the 52-week high. And we're also, building up some volume in and around here, which means it's kind of getting complacent. So I'm a little bit worried about this trading straight sideways, right? So usually when we're talking about buying options, right? When I say I want to buy options, actually I want to buy these options, right? I don't want it to make it look like I don't want to buy these options. I do want to buy options when options premium is cheap. But what I want to convey here is the fact that if you are worried about a sideways move here in this underlying, when you're buying options, that can be very detrimental, all right? Because there is a thief that is coming to pick your pockets, and that thief is called Theta, all right? And it's another Greek. Just think of the thief as the Theta, all right? Or the Theta is the thief, right? Because it comes in nickels and dimes your portfolio if you're buying options. And you can see that really inside of this 35 days to expiration, it gets more aggressive. And this isn't binary, meaning it's not every single night. It's 1 penny, 1 penny, 1 penny from the time that you put this on. No, the closer and closer to expiration you get, that starts increasing incrementally higher, all right? Hockey sticking in a sense, but it's going down, all right? When we're way out here, we can see that that theta isn't nearly as aggressive. So I like to say out here is your buy zone, and inside of here is really your sell zone, all right? So if we've determined options are cheap, which we have, then we're going to kind of lean towards the further duration options. All right, now keep in mind, I did say we're going to be able to counteract a lot of these. And if we can offset the theta, and a lot of the implied volatility and stuff like that, then why not go out in time anyway, right? It's just, we're buying ourselves more time to be right, which is another beauty with using this strategy. All right, so if we're worried about that thief in the night, we can see that we saw it on that, on the chart how it gets really aggressive, right? Well, here, if we look at theta for the calls and the puts, right? Here's the puts, here's the calls. Theta in this column is 13, you know, like 23 days to expiration, right? And theta is like 14 over here on this side. Now, if we look out at 56 days further out there, that was kind of right in between those two circles I had, right? If we looked out here in time, we can see that theta is only 8 cents, right? And if we go even further out in time, we can see it's only 7 cents. We go out to 86 days to expiration. So I was circling out there outside of 70 days to expiration, and this is why. Because if we're in a swing trade, I'm usually in this for maybe a month, 4 weeks, 30 days. That's usually my swing trade length on any given trade. But I still want to take advantage of time, in a sense, in case it bogs down here, right? But something to note with theta, it's 7 cents. So I stay outside in this wheelhouse. Why? Because if we're in this trade during the duration of, say, 30 some odd days, right? Days between, you know, it's not exact, 28 days. But if in that 28 days, if I was in this trade, you can see that the theta only increased just a little bit here, right? From 7 to 8. It only increased by 1 penny. But had I gotten involved in this trade during or in option buying 58 days out, well, look at the next 30 days. Yeah, it's a little bit more than 30 days, but to this one, the theta has increased from 8 cents to 12 cents. Now, if you're thinking 8 cents to 12 cents isn't very much, you know, it's only like talking 4 cents, Eric. Well, you got to remember that option contract multiplier. So for every one contract, you got to multiply everything by 100, right? So that's $4 a day, folks, extra. Actually, $3 a day extra, right? That's just money out the window. If you are a good custodian of your money, you won't let that happen. So you want to get further out in time when you're buying options or when options are cheap. It's just, they seem a little more expensive out here versus here, right? A couple of dollars more. You're spending a couple of dollars more or $200 more in a sense. But I've only, you know, lost that extra dollar a day during the time of this, whereas this, that could get very costly, $4 a day extra, $3 to $4 a day extra, right? So, you know, it would erode much faster, right, on that buy. So let's look at setting up this strategy. I've drawn a couple more lines in here, you know, give us a little bit more perspective, a little bit more data to go on. And you can see that my support and resistance is here. Actually line up quite nicely with this 50-day simple moving average, right? Very nice trajectory there. I've identified the trend, which is bullish. You know, I can see where we're finding support and resistances. I've got the pattern inside of the trend being bullish here. So I'm looking at a bullish thing. My question, though, is right here. What happens if it starts moving that way? If I go out and buy a call and that happens, that's like a death of 1,000 cuts, folks, right? You're just every day, it's just watching that theta just giggle at you. And so if it does this, you know, we don't want to do some of those other strategies we talked about earlier on in this webinar series, right? Where we were talking about the poor man's covered call. Well, the poor man's covered call would kind of work here as well, because we've limited that theta decay in that one and the volatility. So that would be one. But a long call spread, a long call just would not work out very well in a situation where all of a sudden it started trading sideways. So that's ultimately the sideways question mark. Like, if this happens and I want to be a good steward of my capital, I want to limit that theta decay and negate it. I want to get rid of it. I don't want to have to worry about it. So if we're going to do that, we need to start thinking about something like the bullish risk reversal. All right. And a risk reversal, when we use, this is a positive risk reversal is what we used to call it on the floor. If you ever hear just a risk reversal, usually that is something that is associated with a bearish move. And the reason why it's called a risk reversal is because you would put something like this possibly around a stock position. In this case, you would put a bullish risk reversal around a bearish stock position or a short stock position to negate any type of upward move, right? So you could even get a little bit more into this, whereas if you were overall bearish trend in something and saw a bullish pattern within that bearish trend and you had a short position, well then a long-term short position, right? Well, you could take advantage of the risk reversal inside of a pattern swing trade, okay? So really that's what a lot of people would do with something like this. Or on a bullish position, you use the bearish risk reversal on a bearish pattern inside a bullish trend, okay? Does that make sense to everybody? You guys, I hope I haven't lulled you to sleep and everybody's still, we're still here. All right, I'm gonna go with you guys are still alive. All right, so bullish risk reversal, all right, is what it's a risk reversal, but this is the bullish one. That's how it goes. So we're going to be looking at the probabilities first before we find the strikes. And you guys have seen this before. And we're going to look at something like we talked about these are standard deviations, right? And they also line up quite nicely with probabilities, right? That's what a standard deviation curve is. It's just telling us probabilities here, all right? So we can look at probabilities and deltas as being one and the same, really. I mean, when we have a definition of delta, yeah, it tells us what it's going to do to our premiums. You know, that's ultimately what most people will say. Delta is the rate of change in an options premium. I say it's data, right? So when you're trying to remember these things easily, just think of delta as data because it really is probabilities. And, you know, we would say a one standard deviation is around a 16 delta. You know, these are on the call side because it's positive. We'll say this is the put side. So this would be around a 16 delta. You add up all the percentages and you're going to get right around 16% probability of this happening. Well, 16% probability of it happening is a delta. Boom. You're sold. All right. So we're going to look at, and you know, this is the half standard deviation. This is right around 31, 32 delta. I've always been taught, you know, we're going to shoot somewhere around, with this strategy, the 25 delta. So it's going to be right around here. That's the one I like to do. The 25 delta. Why? I'm buying a 25 delta call and I would be basically doing a 25 delta put, right? So I'm buying a call, that's 25 positive deltas, and I'm selling a put, which is 25 negative, selling 25 negative deltas makes that positive, right? So 25 and 25 gives me 50. So see how you would normally think of this, or a trader, an investor, a hedge fund guy is looking at this, you know, versus an underlying stock, right? I have 100, I'm long 100 stock, right? Or short 100 stock. I do the bullish risk reversal. If I'm short 100 stock, bullish risk reversal, I basically hedge 50% of my portfolio is what it does, okay? Because, you know, if I'm long 100 stock, that's 100 deltas, folks, right? Because for every dollar, if delta tells us, you know, the rate of change to an options premium, well, it also tells us the rate of change in the premium, really. But delta, so if I'm long 100 deltas of stock, that means I'm long 100 of that stock, right? So for every dollar move higher in the underlying, I gain $1, all right? So in this case, with a bullish risk reversal, I told you 50 deltas, right? We're long 50 deltas. That means if the underlying moves higher by $1, how much do I gain in value of my strategy? 50 cents, okay? But I also am going to have a nice area of wiggle room where with this strategy, I can keep my powder dry. Like if it starts getting a little wanky and start moving sideways, I can keep my powder dry here. So we're going to be looking at a long out of the money call and a short out of the money put. That's what you get online. If you guys went online to find it, well, you didn't spend an hour with me to just get that kind of BS. So like I said, we're looking at buying. We buy 25 deltas and we sell the 25 delta. Right around there, okay? Now, that's ish, right? It's not always going to give you a 25 delta, folks. But what I like to do is start out here. You know, like if we're going to say step one, look at the put. That's where we're looking to sell, right? Those are the places where you want to look to say, all right, well, where's my support level? You know, because you need to be concerned about your support, your exit, all of those things. So part of that has to do with selling this short out of the money put, okay? Where you're comfortable, all right? Where you would be, remember, when we're selling a put, where you would be comfortable buying the stock if you had to, right? Really, I look at that as, you know, that's where I'm looking to get out with this strategy, though, okay? That's kind of that limit at the bottom where, you know, you start punching me down here on my short put. I'm getting out of this strategy for a loss, right? It would be like it broke the pattern, really, if it came down anywhere near this put. The pattern would be completely broken anyway, and that'd be looking where I got out of this strategy, all right? So the reason why I look at this put, I want to see how much money I collect in order to finance that long call. I ultimately like to do this for a slight credit, just because I like collecting a credit. I like saying, hey, you gave me the money to put this trade on. But it really, you could do it for a small debit. It's going to be so small anyway. But another aspect of looking at this put is that the put usually has a tendency to have more volatility pumped into it, all right? And the reason why that is because people buy puts for protection. And when you're buying insurance, a lot of times they don't really care how much they're paying for that insurance. They're paying up for it, all right? So those premiums have a tendency to get frothy in the puts before the calls do. Now, don't get me wrong, the calls can have some frothiness to them too as well, but usually it's the puts. So when we sell that put, I usually look at how much can I collect for that 25-ish delta put, and then that's going to be the call that I go out and buy. And the beauty is it's not always equal distance away, right? So if I go and look at this 35 or 25-ish delta put, right? I was able to see, you know, I mean, don't get me wrong, it's 27. But I'm looking at it right in between, you know, $1.59, $1.79, so $1.60, something like that. So how much will $1.60 get me? I'm just looking at the price. I don't even care about the strike or anything else, right? So I could do this for a small credit here. Now notice, with this underline, it's trading at $41.28, right? I'm doing a 37 and a 47, right? You would think this underlying right there, if it would be zero, the underlying would be trading 40. That would be equal distance between the calls and the puts, right? This isn't. I'm actually closer, able to buy, you know, a 1 standard deviation call and sell almost, you know, somewhere between a 1 1/4 standard deviation put. So I'm further away. We're looking at this chart here. If I can find my cursor, you know, we're talking about that put. I am talking, or sorry, what was I looking at? The 25 delta put is what I was looking at. So right here, the 25 delta. So, or, you know, sorry, I said 1 1/4. I'm at 0.75. That's why we're going to come back over here. You know, so this 0.75 there. And then, you know, to the upside, I was up there at around this half a standard deviation, right? And currently we're right here. Now, this is where the current underlying is trading. So I've got a lot more wiggle room to the downside and to the upside. You know, ultimately what we want is to have that short call go in the money, right? If that short call goes in the money, the underlying is trading above my, or sorry, I didn't mean short call. We want our long call to go in the money, right? Because calls that are in the money have intrinsic value, have a value, right? It's much better if I'm long a call to be able to buy it lower than where it's currently trading. There is value. We will see those calls increase dramatically once they go in the money, all right? So the beauty of this strategy is it gets aggressively better if we're correct, all right? It'll start working in our favor. If it trades sideways, then, you know, we didn't pay anything. We didn't pay anything for this trade. We collected a credit, right? So we paid off all of that theta, that thief, right? We don't. If we have a credit, we don't have to worry about the thief, right? If volatility goes up and down, my premiums are going to adjust the same, right? Or very close to the same, because the volatility coefficient is going to be very close to one another on those same strike locations. So where do I get out? And I meant to pull up my chart here again. I get out when my short put is breached, right? I have a call up here at the 31 delta call. I've got short the 27 delta put, which lined up with 37 put. Sorry, I should make that delta. And this was the 47 call, right? So as soon as it trades down there to 37 is where I would be looking to get out of this strategy. As a matter of fact, if we notice that 37 strike location, right? 37 put strike location, and I go back to the chart here. Let me erase all this old stuff. If I draw a line here across from here, right, where does that line up with? 38. Well, my put is below that strike location. On a swing trade, the idea is that trade, that bound, or that, you know, that this is more aggressive swing trade methodology. Keep in mind, I'm a little bit more aggressive. I usually don't even wait for it to get confirmed. If I saw this candle, I'd probably, on normal occasions, get in on that hangman doji. So what I'm saying was, I lost my train of thought there, sorry, on the swing type trade. So the idea is more aggressive trader would get out right there, breaking below that candle. The others would say on the confirmation, you know, with this type of trend pattern moving higher here like this, I'm going to follow that trend. So a break below, you know, if you are using support and resistances like I've talked through this, all right, some people would say a break below that area is your exit. With me, I would say you're following this trend, which is this 50-day simple moving average. I'd almost say a break below that 50-day simple moving average, get out. All right, which is what I've done on the last couple of ones where it's broken that on a loss on that 50-day, but it's tracking this nicely. So one of those two ideas would be where I would think to get out. If it happened tomorrow, my right there is going to be, you know, that 38 would be my absolute ripcord if it started gapping or something crazy. But after it breaks that support, all right, and I'm going to follow it up here to, you know, hit that trend top. That's going to be where I'm going to exit. Some people will say, you know, you get out right in the middle. That's not me. I'm going to try and go for those more extremes. All right. So out on the trend to the upside, 50-day to the downside is where I'd exit here. So come up with all those things. Write it down, you guys, especially your exit strategies. And when, you know, what volatility was, all of those things. I like to put that stuff down so that you can go back and look at it. right? You can go back and say, you know what, last time I did this and tweak it a little bit, you know, especially on the swing trade setup. Like maybe, you know, right on the setup, I did it because of the confirmation here, you know. I was a little early, which is what this guy did. I'm in early. I'm in before confirmation. All right. You guys have any more questions? So start out with let's do a little quick review here, right? Swing patterns for swing trades. Identify the overall trend. In this case, bullish. Identify the support and resistances. We did that. We did these trend channels, all right? Trend lines. Then find your pattern within the trend, and I determined that it is bullish within the overall bullish trend. Okay. So then figuring out the option strategies, how we determine pricing of the options, whether they're cheap or expensive, right? That's pretty simple. We look at the implied volatility and see where it is for that underlying. All right. If we're buying options, we want to limit theta decay. It's just all logical, right? If theta decay is less aggressive further out, I want to limit that. All right. And it gives me more time to be right. If I use that shorter duration on a swing trade I thought for sure was going to pop, but all of a sudden these options expire right here and it popped afterwards, then that stinks. I did the strategy for the same amount on the near duration as I would have, 150 days out. I don't expect it to be, I'm not expecting to be in this trade for longer than, 3-4 months. So I'm not thinking 200 days out, but you can probably set the strategy up the same way that way too. All right. And it's not going to cost you anymore. I don't want to deal with it because there's nobody trading out there. You're going to get eaten alive on the pricing a little bit, or could. All right. So you get out of this spot clips with your short put as to avoid assignment. I would just get out of the strategy. If it starts breaking down, well, I'm just getting out of the whole strategy. I probably the only way that I would leave those long calls on, yeah, you could just get out of the put, is if those calls are basically worth like a nickel or a dime or something like that, and it's just absolutely not worth getting out of them, right? I mean, if I want to save myself $5 or $10, that would be a case where, is if I got involved in this and, it trended for a while, right? And then I got a dramatic drop down to maybe here or something like that. I just, it all of a sudden just fell apart for whatever reason, would be the only way that all of that, you get that perfect storm, if you will, where the theta on these is pretty much gone. We're very close to the expiration and you got that drop. Yeah, that would be a time where I'd just say, all right, maybe I'm just going to take off the puts as if this whole strategy is just getting ripped out, and leave those long calls on because they're only worth a nickel, dime, maybe a quarter, whatever your pain point is on, whether it's worth trying to salvage some money from this strategy, right? Or just willing to say, hey, I'm willing to let this other, $100 ride kind of thing. Does that make sense, Will? But yes, to avoid that assignment risk. Now, keep in mind with this strategy, obviously, if somebody was a jerk and kind of assigned you on this strategy, yeah, you're just going to basically have to go, you have the call to offset it, but I don't think you're going to want to use that call way up there to offset it. I'd probably just go out there and, buy it in the open market to offset it. But absolutely, I like to try to avoid assignment as often as possible. Usually your puts are going to have to be very near expiration and before you ever get assigned. Like they can be deep in the money and you never get assigned on those, because everybody trading, any real trader trading options knows there is no benefit to, exercising your right to fulfill the option contracts. Okay. because you're leaving money on the table. And I explain that in other videos and stuff like that. But no real trader. It's going to be some rookie that came in and just happened to, you got Russian roulette on the assignment risk, unless it's inside of like 7 days. Inside 7 days to expiration, that's probably where you're going to have to start worrying about it. But if you're 30 days out, you're probably, the probability of you getting assigned, even if they're deep in the money, is pretty low, in my experience. All right, folks. You guys, thank you for sticking around. I appreciate it. Here's your offer. We're going to give you guys this for participating. This is down to, I think last I heard, I checked yesterday, 50 more members will accept into this program. I can't do too many, you guys. It gets a little overwhelming, I'm going to be honest. But in this promotion here that you guys get to take advantage of, I will be your mentor in a sense. Like, you can think of me as your mentor. You can lean on me. Reach out to me anytime. I will make sure you are clear of concept. We'll bat it back and forth based on theory of what I believe and all of that stuff to help you out in trading. So make sure you take advantage of this. For $97, you get a mentor and access my entire library of everything past, present, and future. So you get a good deal. I'll throw this over there. Thank you. I appreciate it. Everybody's like, where's the link? It's in the chat window. So if I throw it over here in the questions box, you guys are going to have to type it into your URL. If you're watching this live, the chat window is the best way to do it. If you're watching it on tape delay, yes, you'll probably have to pause and type this into your URL. But otherwise, there's hundreds of hours. I think the last I saw there was like 600 videos in there you can watch. So yes, you get a lot of content and access to me on a daily basis. Does this offer include these option strategies you talk about? Yes. Yes. All my option strategies, I talk about all the option strategies, the ones I will trade, like there are a couple of option strategies I will not trade because they just don't make sense. And I talk about why they don't make sense and why I would never trade them because it goes against all the logic as far as I'm concerned. But yeah, take advantage of this. The link is over there in the chat window. You'll get all kinds of stuff that I just can't even list at any given time. All right, here again is the link. I want to thank you guys all for participating in this webinar. You guys really do help create the content, keep this flow going. And thanks for watching. If you have any questions, comments, or ideas for future webinars, something you want me to talk about in the daily market commentaries, if you're a subscriber and you're looking at a particular stock and you want me to take a look at it and do some detailed analysis in it, reach out to me. I'll do that. Absolutely. Trading on ProTraderStrategies.com. All right. And finally, yes, we do have a disclaimer. I'll get to you in a second, Will. Please take a moment to go over the disclaimer, as we are an educational company. We're trying to teach you guys how to swim. We're not trying to swim for you here, right? Oh, yeah. So I think I already answered you, Will. There you go. All right. Perfect, guys. That's all I got. I appreciate everybody taking the time out today. If you like the video, please smash that like button. Comments down to the bottom. I'll reach back out. I'll make sure you guys are clear concept. But the like button does help. Help share it with your friends. All the good stuff. Other than that, if you can't take that, take it easy. Take care, y'all. Bye for now. Thank you, Dan. Appreciate it.